Thank you for joining our market update webinar on the impact COVID-19 is having on cash portfolios. I'm Shane Fearman, Director of Marketing at Campbell Advisors Group, and I will be your moderator. Joining me from their home offices is Ben Campbell, CEO, and Lance Pan, Director of Investment Research and Strategy. I'll now hand the presentation over to Ben.
Thank you, Shane, and welcome everyone. It's a pleasure to be hosting this webinar today remotely. I know there have been many conversations with Kate, Mark, and Siobhan in the PM group regarding the current market conditions, but I thought that the idea of today's webinar is to continue the strong communication lines as well as we sort of all of us navigate this very challenging time. To look at the agenda today, while there's lots of analysis on the spread of the virus and the future economic impact of the virus, today we wanted to focus our conversation on the impact on one's cash holdings and look at the strategies that support liquidity and safety in this environment. So we're going to be sort of very focused on the various programs that impact the individual securities in our portfolios and the other exposures that we have. So for our agenda this afternoon, I wanted to give a brief update on Campbell Advisors Group. I wanted to look at the current market situation, explore the various market support programs that have been introduced by the Treasury and the Fed, and then review our investment strategies in regards to how it supports the objectives of safety and liquidity. So why don't we go to the next slide and we can jump right into it. So regarding Campbell Advisors Group team, both here in Boston, San Francisco, and in New Jersey, we've all transitioned to a remote working environment, and I'm glad to report that between trading, credit, operations, as well as interfaces with the custodians, all is working well. In the beginning of March, we started to go to a sort of rotational program with our trading and our credit groups so that we had 1 week on and 1 week off so that people could have their home offices set up in advance so that if we did have to start working remotely, that would all work. And aside from that, I think about 40% of us are remote to begin with. Our traders sort of start by hosting the day with a morning call to update the team on the latest information from our dealer network, which then feeds into our investment and credit committee calls to sort of assess the market developments. This is a good environment for all of us to start our day. So we get a lot of sort of current feedback on how things are trading and what are the trading firms that we deal with, what they're seeing on the street as well. And I think all that sort of feeds into our other meetings. I'm also very happy to report that all of us are healthy, although I know that some of us have young kids at home and they're probably a bit more stressed in juggling all of this than what they're usually doing. So to move on to the COVID-19, economic shocks have come in many different flavors over the years. In 2001, we had a dot-com bubble that burst, and that was sort of a speculative bubble that caused a significant market correction. In 2008 was a structural credit issue that ended up with very much of an elongated L-shaped recovery, as it took a lot of time for the balance sheets to repair themselves and for the overall market to start functioning properly. In contrast, this shock, the COVID-19 shock, is entirely government orchestrated. It's effectively a government shutdown of major sections of our economy, but it's combined with immediate economic support. And so I think this economic support and the fact that this shutdown has a beginning, middle, and end to it, and I think that the data will start to tell us, while we don't know these midpoints or these endpoints at this point, I think the data will start to point to that as we go down the timeline. So I think that understanding that this is an orchestrated shutdown, the possibility of a U-shaped recovery or potentially a V-shaped recovery versus 2008 is significant. All this being said, 2 weeks ago, the initial phases of this caused a very powerful market dislocation, leading to significant illiquidity. Matter of fact, there was illiquidity that we really hadn't seen since '08. Fortunately, the Fed and the Treasury have been very quick to react to this, and they've been able to dust off old programs from '08 and pull those off the shelf very quickly and put those in place to start to support market liquidity again. And unlike '08, in '08 this response was a bit of a slow drip. In the last week or two, the Fed has been very quick to bring a lot of things to bear on the market, because I think a lesson they learned in '08 is there's no point in delaying these programs, and they may as well bring everything they can to the market for market support. So these programs have been critical in restoring market function for many of the short-term securities. So I would like to, at this point, turn the discussion over to Lance to review these programs specifically and look at the securities that they impact, which are many of the securities that we're all participating in.
Thank you, Ben. As Ben had mentioned, that we came into this situation not because of anything wrong in the economy or any credit event, but simply because of an external threat, the coronavirus, COVID-19. So faced with uncertainty, the financial markets behaved the way as they were expected. Basically, it was just do nothing. So the Fed's primary job was to get the financial markets going again. That's why the Fed tried to attack the illiquid part of the market, and they try to provide more liquidity. There are other monetary and fiscal initiatives being taken elsewhere, but we were just going to focus on Fed for the time being. So slide 4 basically gives us kind of the 4 buckets of the security classes that most cash portfolios will be in. So there are the governments, like treasury agencies and government funds, the first bucket, and the second bucket will be CDs, bank debt, or financial CPs. And the third one would be corporate CP and corporate debt, municipals, as well as prime funds that buy them. And lastly would be asset-backed securities, ABS. The reason I laid out that way is so that we know that at least for illustrative purposes, the programs the Fed introduced would benefit each of these buckets of security types. I just wanted to point your attention to the color coding on this slide. The ones that are coded green basically are were the programs the Fed had in place back in '08 that they were being brought back fairly quickly, as Ben mentioned. And then the green lines indicate something that's slightly different from 2008. These are new programs the Fed did. Not necessarily they didn't do it in '08, but the ones that they brought back will be significantly different. So I just wanted to, let's say, go from the bottom up. You will notice that the Fed actually cut interest rates twice from 1.5% to 1.75%, all the way down to 0. So that's to set the bottom in terms of the credit cost for the market. And they also restarted the quantitative easing, basically buying large quantities of government debt to provide liquidity, provide the support in the government market, the treasuries market. And then they also, in order for them to let the banks to intermediate the liquidity to the broader economy, so the Fed and OCC and other banking regulators allow the banks to relax kind of their compliance in certain capital and liquidity standards, so that banks will be less handcuffed to provide the liquidity to the marketplace. And then moving on, the Fed did try to provide liquidity in addition to the banks. It also provided liquidity to the non-bank dealers. These are the dealers who don't have access to the discount window, allowing them to borrow from the Fed and then lend to the broader economy. And they also instituted a money fund liquidity facility, again, to help out prime funds to maybe have liquidity for the non-government security they own. And you continue to move up. Repo operations was about from a few $100 billion back in September of last year, all the way up to $1.5 trillion. Again, these are daily, weekly, quarterly repo operations to provide liquidity in the marketplace. So I'm not going to go through all of them, but there's also the commercial paper funding facility that will allow large tier 1 rated corporate issuers to go in the market and actually issue to the Fed at a decent level. So that provides them with kind of a backstop if they couldn't get a funding from the private market. And of course, there's the programs that were just released later that have not been put in place, the primary market corporate facility and then a secondary market corporate credit facilities. And these are new facilities that actually were not used before, and they're actually the Fed's intention to buy corporate securities to further to support the marketplace should they need it. Our experience has been back in 2008, even though some of the programs that the Fed introduced that you see here, the Fed actually did not fully utilize those, one of which was the term asset-backed lending facility that was specifically to address the consumer lending side, the credit cards and autos and student loans of the world. The Fed put in place, and they really that program wasn't utilized as a great deal because that was towards the tail end of the crisis. But that's the intended purpose of the Fed, to put these programs out there so that the need to use them will be lessened, therefore to remove the liquidity issue there. And the last bar at the very top was the fiscal package that we are aware of now. That's the CARES Act that the government pumped $2 trillion in the marketplace to provide relief to both individuals and businesses, as well as allow the Fed to have additional capital to introduce new products or new programs if needed to help the economy. So I'm going to turn it back to Ben to talk about slide 5.
Thank you, Lance. I wanted to make a few comments on portfolio construction, because while there are a lot of programs, as Lance just reviewed, that are specifically designed to support different segments of the short-term markets that we all participate in, we have each market crisis that we've been through has influenced our investment process and our portfolio construction. And I think we're very deliberate on how we build portfolios, and that's not for how our portfolio will perform on a sunny day when the economy is roaring along and everything is good, but it's really to buttress a portfolio to when stress starts to show stress or recessions or other shocks come to the economy, because our job is, number one, preservation of capital, and number two, liquidity for our clients. So I did want to spend at least a few minutes on explaining sort of what our thought process is in the construction. As you can see from this pyramid, the foundation for everything we do is liquidity management, which covers monthly cash burns, liquidity cushions, and the next block up is very detailed credit research, research of exposures and safety of those exposures. And then lastly is diversification and best execution. So I wanted to, if we could go on to the next slide, I wanted to dive into some of these elements in a little more detail so people could get an understanding as to what our thought process is. First of all, in the projected cash needs, as all of you know, we ask for burn rates and outflows from the accounts, and we send a liquidity forecasting model to you every 2 weeks so that those numbers can be updated. And from those numbers, we know that we have to have X dollars liquid and ready to fund operations on the first of every month. We also take a look at that number and build a cash cushion or a liquidity buffer above that number. Now, that may be the exact cash cushion, or it may be 2 times burn rate or 3 times burn rate, and that really depends on the business model that we're servicing. So, and I think that from that liquidity buffer, we then build individual securities that provide organic liquidity that constantly feeds both the liquidity cushion and the cash burn rates. And the reason that we buy individual securities is we're a big believer in portfolio diversification. And we think that that portfolio diversification actually reduces the risk profile of the portfolio versus being loaded up on a money market fund or deposit products to meet liquidity needs for the overall portfolio. So when we look at the portfolio diversification, while each of our clients, or everyone has an individual investment policy, we actually have a Capital Advisors Group sets our own limits and has our own internal investment policy that covers sector levels, asset classes, even country limits, and that's a working document for us. So as we go through different environments, we're changing the percentage that we would allocate to different sectors, the percentage we'd allocate to different asset classes, as well as individual securities. We even go to the trouble of setting individual maturity limits on a per issuer basis. So there's certain securities on our buy list that are only approved out to 30 days, others that are approved out to 1 year, and others that are approved out to 18 months. Finally, and one of the reasons why we have this portfolio diversification is we want to have a general under-reliance on shared liquidity products. And what I mean by shared liquidity products are deposit products such as MMDAs, DDAs, and these are amounts above the $250,000 limit, ultra short-term bond funds, prime money market funds, really any vehicle where your cash is pooled with other investors. We do have exposure, but that's only in the highest quality treasury and agency money market funds, and that's through one of the largest sponsor of government money market funds in the country. And those are limited to just the investments of the cash cushions and the projected liquidity needs. So this investment process and this credit process has been developed over the last 15 years and really serves as a foundation for our security selection. So I thought at this point, just to give a little more detail on that process, I wanted to pass it back to Lance that can spend a little bit of time talking about the credit framework that we use and talking about the credit selection analysis process that's embedded in our credit department.
Yes, so we have been through a number of major market events, and the process that we go through with our credit evaluation really hasn't changed, and that really has helped us navigating through these troubled waters. And for majority of our clients, this should not be unfamiliar to you through our communication through our portfolio managers to you. So our credit framework really starts with a strong approved buy list. And this is basically to say that all the credits that we buy in a client's portfolio will be pre-cleared. We call them pre-trade compliance. So what that means is even before a PM needs to say, I need to buy something, there's a list there that's been provided by the credit department that's been fully vetted and approved, waiting for the traders to go out to the marketplace and source the best execution price. So our decision is independent of the PM group or the traders' decisions. Number two, we do have the tier maturity structure, as Ben had mentioned. Depending on our comfort level, we would allow the traders to purchase certain securities to a longer maturity versus a shorter maturity. I have to stress that because we deal with very highly rated short liquid products, principal preservation is very important for us, but it's probably not the primary factor because, again, they are very high quality. So we place more emphasis on being able to offer the most liquid security in the marketplace, and that really drives our decision. But for example, some names may be very strong but tend to have headline risk. Then those are the names would receive a shorter maturity limit. Number three, all the credits will have to be vetted by a credit committee. I'll talk about that later on. So it's not an individual decision, but that involves the credit department, the senior portfolio managers, the head trader and the executive team, Ben, and as well as our president. Everyone would have a chance to vet that credit. And also, it's very important for us to increase our risk exposure. It takes the decision of the entire group to approve it. But if we feel that there's certain risk that's emerging in an individual credit, then the credit department will have the unilateral decision to remove that credit or reduce their exposure. So this asymmetrical decision tree actually allows us to quickly move on problems that may be developing amongst our credits. Number 4 is really the bread and butter of what we do every day. Is we are in the marketplace. We offer surveillance. So we look at rating agency reports. We look at third-party research, press releases, government reporting, and just market signals, whether they're stock prices, bond yields, credit default swaps, and a number of other quantitative and qualitative factors that we look at. So that allows us to see not only what we believe the credit developments from our own analytical tools, but what the market perceive that particular credit. And lastly, as some of you are also aware that we do have our own credit scoring system, our private rating system, if you will, called the Counterparty IQ. We look at a whole number of factors that would help us make those credit decisions. I think why don't we just go to the next slide? I'll have time to talk a little bit more about that, our Counterparty IQ. Again, just to reiterate, on the left side, this donut hole structure really tells us a 5-step process. I don't want to spend too much time on that. Basically, we start with a universe of names. We call the universe definition. These are typically, as you know, A1, P1, short-term, or A2A securities within certain limits. And then we run it through a idea screening process. This is the kind of the initial cut. For example, names that don't meet a certain ratings requirement or industry requirement. For example, we've never gotten into airlines industry. We've never bought any utilities name. We've never gotten into tobacco products, things of that nature for our credit, majority of our credit portfolios. That's our screening process. The third step is what we spend the most time to build credit model, to look at the fundamental as well as the financial performance, whether it's profitability, their leverage ratio, their debt paying ability, a number of credit metrics. And we spend time there, as I mentioned. The fundamental, and every credit has a fundamental analyst that's leading the research. And then once the analyst has the recommendation, that the credit department would approve it. And then it goes to the credit committee and we approve it. And then lastly, step 5 is what I'm going to talk about, this ongoing monitoring process. So in a nutshell, look at the table on the right-hand side. We build a model based on what we think of all the factors in the marketplace or a firm's operating conditions that way may impact its credit strength. We will pick that factor and then we will summarize them into something a little over 100 of these individual factors. And then we assign specific credit scores to say if a certain performance reach a certain level and they'll get a certain score, roughly, let's say AAA, AA, single A. And then those scores get funneled down to what we consider as 4 or 5 major categories. For example, in the middle part, we call them market signals. This is what I mentioned about stock prices, CDS spreads, implied ratings. And then macro scores will be how the general economy, whether we're in a kind of an upswing or downswing, whether we're in like an easing environment, tightening environment, things of that nature. And then a sovereign support because we are in a lot of financial institutions' debt, so we have to ascertain whether the institution receives some implicit government liquidity support. So that gets factored into our decision tree. And then the big chunk of our time will be spent on firm fundamentals. So those are the specific credit metrics we're looking at every quarter. We update our information every quarter. We combine that with our market information every day. That gives us a composite credit picture. So if and when things do change, and we will make our decision accordingly. And that's what we go by, this overall score for individual credit. So when we manage a client's portfolio, and we also be able to derive a composite score, so we kind of can take a temperature of that credit portfolio regularly on a daily basis or monthly basis, and however frequent the information becomes available. So I'm going to push it back to Ben to wrap it up.
Thank you, Lance. This is not normally detail that we share with clients on the credit side, but I think it's important, especially as we get into more stressful environments, to understand the homework that goes into our credit selection, understands the homework that goes into our what sectors we're in, what percentage we're in or not in other areas. And early on, we realized that the rating agencies and Moody's and Standard & Poor's and Fitch are sort of good for what they are, but they don't. The number of factors that they don't include, which we've included in this, is, for example, the market signals, the macro scores, the sovereign external support. All of that is factors that we think influence how credits are going to trade and the strength of credits, and think needs to be included into the analysis. So we've actually externalized this credit process after the Lehman debacle back in 2009, and it's used by a number of Fortune 500 companies to sort of help track their counterparty risk and also augment their internal credit efforts. So, and it was as the market went through the stressful environment 12 years ago, we were we had a lot of research that we had published on credits. So we started to get a bit of a following, and we were sort of asked if we could provide this as an outside service. So we're running up against our half-hour limit, and I know that we're running into quarter end coming up tomorrow, so I wanted to keep this to a half hour. But I did want to summarize several themes that we've been discussing today. First and foremost, we expect market conditions and liquidity to continue to improve, certainly as we get into April and the various government programs that Lance talks about either get fully implemented or get into the implementation stage. And I think this is very positive for both market function and positive for all of the holdings in the portfolios that we manage. Secondly, and we've sat down as a group, and I've sat down with the PMs, and we're very comfortable with the well-planned liquidity and the liquidity buffer that is currently in the portfolios, and we're very comfortable with the credits and the diversification of the portfolios. The last thing that I wanted to leave everyone with is our whole team, from operations to traders to portfolio managers to our credit analysts, are here to support you and the strategies that we've built. So feel free to reach out to myself directly or to Lance or go through the portfolio managers, but we will do whatever is needed. And we know this is a very stressful time for everyone. We're here and we're prepared to do whatever is needed to support everyone as we sort of go through the next month or two during this very challenging time.